Hi, this is Roger Conrad. I'm editor of Canadian Edge. What I want to talk about today is some of the things that I've observed, some of the takeaways from the recent earnings season and on into what we can expect for the rest of 2010. We had some obvious underperforming groups. I think anything involved with home heating, for example, had posted some unfavorable comparisons. Anything involved with hydropower generally didn't do so well either. Of course, these are for reasons that are largely beyond these companies' control. And what we do when we pick these companies in these areas is look for strong cash positions, look for strong long-term revenue generation and reliable bounce backs. When we do have low water flows. And diversification of assets. And what we come up with is, even when we do have these quarterly shortfalls, are companies that can weather the storm, continue paying the dividends, and chances are our cash flow is going to bounce back in subsequent quarters, restoring the cash balances to the levels. Again, not every quarter you're going to see blockbuster results in companies that to a large extent depend on weather, the factors beyond their control. But over time, a good company will be able to turn that to their advantage, continue with their capital spending projects. And if you look at our power trusts like Brookfield, like Intergex, like Macquarie, like Atlantic, they're all continuing to invest money. So, and even with some occasional quarterly shortfalls. So, again, we're very confident in those companies, even though payout ratios are a little on the high side here in the second quarter. Turning to a group that, on the other hand, is doing very well, and that would be the energy services and particularly and also oil producers out there. And these companies have had a tough go, particularly the energy services companies. But the second quarter of last year was so bad that this year we're really seeing some very, very strong comparisons. Some of the companies out there basically doubling or trebling cash flows. Again, enjoying some very nice pickups in utilization of drilling rigs in particular. For oil companies, again, very strong oil prices. And they've been generating a lot of cash flow, so they've been growing production and therefore realizing high returns from that. Even some of the gas producers, and gas prices have been absolutely miserable, and these companies have been doing fairly well, some with natural gas liquids and so forth. But in any case, some very nice comparisons, and that's certainly very welcome news going forward. What does it all add up to? Well, I think what we're going to see, and this will be a theme of an upcoming of the September issue for Canadian Edge, and that is a return to dividend growth. We really had a lot of dividend growth throughout the trust sector, throughout Canada, prior to October 2006. And of course, that's when Prime Minister Jim Flaherty, or Finance Minister Jim Flaherty rather, announced the trust tax, and that trust would be taxed in the year 2011. And of course, we've seen since then kind of a period of retrenchment for trusts. Some of them were taken over. Some of them most of them basically took the idea that we're not going to increase any distributions anymore. We're just going to see what we can pay when the taxes kick in 2011. And that's one reason why more than half of the conversions that we've seen so far to corporations have not involved a distribution cut. In other words, the trust has kept the same distribution as it turned to a corporation as it paid as a trust. That's certainly something very few people expected. We count ourselves as pretty optimistic folk, but with regards to these dividends, that's been well beyond anything we expected. And even the companies that have cut distributions, they've been less than expected. And that's been the game. So again, that's been the game the last 4 years. What's the distribution going to be in 2011? But what we're seeing now is with this transition being made, companies setting distributions at levels that they can be increased off of. In fact, the companies in our portfolio and all the companies that we've recommended in Canadian Edge have a growth component. We are not people who just buy for yield, never have been, never will be. And in fact, our basic thesis is that you don't get growth or income very long without the other. So all our stuff has been growing, and now I think as we make this turn from trust to corporations, as these taxes become into effect, we're going to start seeing a resumption of distribution growth, dividend growth across the board. We're already seeing it in some of the areas. Some very strong dividend increases from some of our holdings, like New Alta Corporation and Northern Properties announced just this over the past couple weeks. And I think we're going to see again some acceleration across the board as these companies convert, as they start paying taxes, and as we start seeing what they start earning as corporations. So this is something. I don't even think that the fact that have there been so few dividend cuts has really been priced into the income trust group or the converting trust group by any extent. I think you're still seeing yields of 9, 10, 11% precisely because people distrust the whole picture. And a lot of people are still looking for some sort of doomsday to happen in 2011, which isn't going to happen because, in fact, at this point, only about 10% of the former trusts have not told us exactly what their dividend's going to be when they convert, or else have already converted. So there's very little uncertainty regarding the 2011 taxation issue out there. But again, high prices indicate that they're still pricing in some more bad news. So when we get through that transition, I think we're going to see a nice revaluation of a lot of our favorites. That means higher prices. And then we're going to see a resumption of dividend growth, which is going to give us an even greater boost. Before 2006, we saw prices of our income trusts move pretty much in line with their dividend growth. There's variation from week to week, quarter to quarter, day to day. But generally, as dividends rose, so did the share prices along with them. We're going to get back to that, and it's going to begin next year. And again, very good reason to hang on to not just any company even in our universe, not just any Canadian company, not just anything because it has a high yield, but our fast-growing, strong businesses that pay high dividends. They're in very good position going forward. So that's all I have to say today, and I look forward to chatting with you next time.